Roku and the Trade Desk are two companies that are benefiting from more people watching content through streaming or connected television devices. Of course, they both also generate significant percentage of their overall company revenue from advertising, and advertising, I've said repeatedly, is one industry that I expect will grow in every 10-year period from now into eternity because of the connectedness of advertising to our worldwide economies. I don't expect any 10-year period to include a decrease in advertising spending. So all that being said, powerful tailwinds supporting these two companies, you can understand that it could be attractive investments for long-term buyers. I'm going to compare these two and answer which one I think makes the better one to buy to benefit from these trends.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
To start the comparison, I wanted to look at revenue growth going back to 2015. Roku has increased its revenue from 300 million to 4.4 billion. That's good for a compounded annual growth rate of 32% in that time. Meanwhile, the Trade Desk has done better than that, even increasing its revenue from 100 million to 2.7 billion, which is good for a compounded annual growth rate of over 39% in that time. Looking forward, I expect the Trade Desk to generate better revenue growth than Roku, even though in the near term, Roku may exceed the Trade Desk because it's ramping a new segment where it's manufacturing and selling televisions. That could increase the company's revenue, but also hurt the company's profitability, as margins on television sets are likely to be less than margins in its platform segment, where it generates much larger revenue. Historically, the company's hardware segment, or player segment as it calls it, generates either very low or negative profit margins, and I wouldn't be surprised if its television sales are not generating very much in terms of margins, but the company's okay with that, because if someone buys their television that comes equipped with the Roku operating system, that will generate revenue for the company for many, many years, as the folks that are watching the content on that television will purchase streaming subscriptions and get shown advertising, and all of that will benefit Roku. Meanwhile, the Trade Desk is facing stiffer competition as Amazon and Netflix and others are encroaching on its space by offering inventory to its lucrative advertising supply, directly skipping the Trade Desk. And investors have become concerned how that could impact the Trade Desk longer term. Still, more and more people are watching more and more content through connected televisions, and the overall size of the pie continues increasing. The advertising industry estimated to reach $1 trillion, or roughly $1 trillion in annualized spending. And within that annualized $1 trillion in spending, digital advertising is increasing to take a much larger share, as you can generate better measurement, better return on ad spending, and evaluate the performance and target your advertisements more specifically, which of course is better for marketers and enterprises. So they're both benefiting from these tailwinds longer term. The next thing I wanted to compare these two on is their operating cash flow to sales ratio. And in this metric, the Trade Desk demonstrates its superiority again, generating a 34.7% OCF to sales ratio. That's up from around 9% in 2019. Meanwhile, Roku generated a 9% OCF to sales ratio, up from 1.2% in 2019. They've both demonstrated improvement in this metric, while the Trade Desk at 35% generates a much stronger cash flow to sales ratio, giving the company sufficient cash flow to invest in new technologies and buy back shares if they see an attractive opportunity with the stock price trading at lower valuations. The next metric I wanted to compare these two on is the return on invested capital, and they've both demonstrated less improvement in this regard compared to their OCF to sales, partly due to increasing investments in new technologies and partly due to the decelerating revenue growth. I showed you earlier they've generated revenue growth over the previous decade at compounded annual growth rates of over 30%, closer to 40% in the Trade Desk case, but those levels have fallen significantly in recent quarters to around 10% for Roku and closer to that figure for the Trade Desk as well, a fraction of their historical compounded annual growth rates. The company's return on invested capital for the Trade Desk at 27% is down from over 60% in 2017, but an ROIC of 27% is really strong, especially comparing it with the weighted average cost of capital for the Trade Desk, which is less than 13%. So the company boasts an over 2-to-1 ROIC to WACC ratio. Meanwhile, Roku's ROIC is still negative. Even though it's demonstrated improvement over the previous decade, that improvement is not as quick as I would like to see. However, looking over the shorter time period from 2022, they've demonstrated much better improvement, improving from negative 32% to negative 9%. However, if you look back for the previous decade, they went from negative 29% all the way up to 23% during the pandemic, which of course was boom times for Roku, and then collapsed back again, and now they're rebuilding. And it remains to be seen how the investments in manufacturing television impacts the company's return on invested capital numbers in the longer term. Now that we looked at the company's performance metrics, let's look at valuation. And my proprietary discounted cash flow calculation for Roku has the business worth $101 per share. Current market price is $95. So I would say Roku stock looks fairly valued based on this valuation metric. Meanwhile, I calculated the same for the Trade Desk and found its intrinsic value to be worth $67 per share. The current market price is $50 per share. So the Trade Desk stock looks undervalued according to this valuation metric. But I also like to look at valuation on a market-based multiple, and the multiple I'm going to use here is the forward price to operating cash flow, because Roku's earnings figures are negative and not consistent enough for me to use the forward price to earnings metric, which I prefer to use instead of the forward price to operating cash flow metric. Regardless, comparing these two on this metric shows the Trade Desk trading at a forward price to OCF of 26, while Roku trades at a price to OCF of 18. So the Trade Desk is trading at a premium valuation compared to Roku. And the first question I ask myself when I see this is, does the Trade Desk deserve to sell at a premium valuation compared to Roku based on what we saw in the performance metric? And just to review, the Trade Desk has generated better revenue growth than Roku over the previous decade at 39 compared to 32. It's generated better cash flow to sales, most recently 35 compared to 9. It's generated better ROIC, most recently 27 compared to negative 9. So to answer my own question, does the Trade Desk deserve the premium ahead of Roku? The answer is yes, and resoundingly so. I believe it deserves a sizable premium compared to Roku. I think it's meaningfully ahead of Roku in those critically important metrics. And so a premium of just 8, I think, is reasonable. And if I had to choose between these two, remember, I have them both rated as a buy. I like both of these companies at their respective valuations. But if I had to pick between these two, I would pick the Trade Desk as the better stock to buy. And in fact, I own the Trade Desk stock. I bought it a few weeks ago, and I made a video informing you all of why I made that purchase and why I liked the Trade Desk stock at the valuations I was able to buy. So if I had to pick, I would pick the Trade Desk, but I like them both.
Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.